we're looking at a close finish for the NASDAQ here, trying to go positive on the day. Let's talk some stock picks and more with David Trainer, for joining us from NewConstructs. David, I want to get your take on the overall market. As we've spoken in the past, correct me if I'm wrong, generally it's been your view that over the last couple of years we've seen kind of a lot of flimsy fundamentals. So what do you make of some of the action here as the NASDAQ has led some weakness in the market the past couple months?
I think investors are trying to find their footing. You know, what's real and what's not real. And we know that a lot of sort of fake news and fake performance has come out of COVID. A lot of misinformation. I think, you know, the noise to signal ratio, aka Wall Street bets, is at an all-time high. And so I think investors are struggling to figure out, okay, where's a safe place to put money? Because we think maybe the game is starting to sort of peter out. Investor participation is on the decline. I'm sorry, retail investor participation is on decline. And I think they're searching for reliable fundamental research to give them some sort of basis, a little bit of easier to sleep at night, I guess, idea, Oliver, is what I'm saying.
So the companies, and I know what you're hinting at here, the noise to signal ratio, right? I mean, look, stuff like GameStop today bouncing back 50%. The call buying of far out of the money bullish plays has faded somewhat over the last couple months as those stopped paying off in companies like Tesla, et cetera. Are there companies that, to you, look like solid ground in this market that are sellable to traders who've gotten used to seeing new highs getting printed every day?
You know, look, I think there are a lot of great stocks out there, and that's why we're not saying the whole market is going to crash, right? We call it micro bubbles. And there are plenty of stocks, they're easy to name, that are trading untethered to fundamentals. And there are plenty of great stocks that we think are still great values, great companies that investors could really feel safe with and probably see much better returns over the next 6 to 12 months than some of the crazy ones and the popular ones that have, like GameStop, that go up and go down, right? But, you know, as an example of a company, a great company, a great stock that is not getting the love it deserves is GM. You know, look, they're switching over their large manufacturing capacity to do electric vehicles. They're going to get into the market with scale. And Oliver, the thing people miss is that GM loves what Tesla has done, because GM has created a demand for electric vehicles at a level that they can produce with scale. And so they can come in, produce, I don't know, as good, maybe a better car than Tesla. Doesn't have to be as good, just has to be a lot cheaper and address a much larger market. And yet that stock is trading as if its profits will permanently decline by, I think, 20 or 30%.
Even after the run? GM's had a nice little run here.
Oh, yeah. You know, it's been on our focus list for a while, and it's had a great run, but it's still trading as if profits will decline by 20%. So it was real cheap. And so you can't, you know, you juxtapose that with Tesla, where profits are supposed to sort of, you know, go to the moon or Mars, whichever line goes first, right? Whereas with GM, you got a really well-positioned company actually making money whose profits are expected to decline when you look at the current valuation.
Now, I know you guys have kind of your own proprietary method of thinking about valuations. When you say it's price to see profit decline, is that different from what, say, analysts estimate the company is going to generate? What do you mean by that exactly?
Yeah, what we do is it's a very objective mathematical way of looking at valuation. We just reverse engineer what the cash flow life cycle has to be to justify the current stock price, right? So we don't use a DCF to try to predict the future. We use a reverse discounted cash flow model to understand what kind of future is baked into the current stock price.
Interesting.
And so when you look at the stocks, you know, on our list today, GM, Target, JP all of those have valuations that imply profits will permanently decline by 20 or 30%.
Okay, interesting. All right, so GM, you're saying has some ease in its ability to maybe beat those expectations, right? You mentioned Target. Let's go there. Target was a favorite for a while, David, and then it just like hit this wall around its last earnings, one of the more wild responses to earnings, but we've closed that gap from its sell-off. It seems to be back in favor. We're a few bucks below the high.
Yeah, you know, look, we think Target's got a lot of room to grow. They are, among all retailers, the best at this omni-channel distribution. And let's face it, it's now omni-channel. It's not the retail, you know, the narrative around the retail apocalypse we think is overstated. We think a brick and mortar presence is helpful. It's got to work well with an online and pick up and all that. And Target's done an amazing job with their omni-channel distribution strategy. They're also doing a great job of bringing stores within stores. They've got an Apple store within their store, which is terrific margins for them. You get an outside vendor to do all the merchandising and work for you, and you just get a piece of the revenue. And so it's a very high return on invested capital business, 15% return on capital. And again, a stock whose valuation implies its profits will permanently decline by 30%. Right? So that's just good risk reward. Buy low expectations, sell high expectations. And it's so much better for the retail investor, because when you're buying cheap stocks, right, they got a whole lot less downside because they're already cheap. And they've got a lot of great upside, as more people start to turn to reliable fundamental research to make investment decisions.
So what does your model show for JP Morgan? I mean, nobody really hates this stock. This has been one of the best performing banks. The fundamentals are there. We've seen the earnings beat expectations. We've had a couple great reports in a row from this company. Stock's been rallying. You are still applying that kind of same approach here for JP Morgan, though, that it's underestimated?
Yeah. We don't care about analyst estimates, right? Whatever they're predicting for the future. And by the way, a recent study shows that analyst estimates are off by about 20% of the time, right? There's a lot of noise and bias because people don't read footnotes, analysts don't read footnotes. Those numbers aren't any good. So what we care about is what the cash flows have to be to justify the stock price. JP Morgan is another one of these stocks. It's trading as if its profits will permanently decline by 30%. And Oliver, this is a business that's grown profits consistently for decades, right? So the idea that the profits will permanently decline by 30%, pretty absurd, especially considering their scale, their reach, their industry-leading return on invested capital. It's a best-in-breed business. It's kind of a no-brainer, right? I mean, you buy a really good company, really high returns on capital with a valuation that implies it's going to basically almost go out of business. I mean, you got to love that kind of risk-reward.
Okay. All right, David, thanks for the companies that you like here. Always interesting to get you guys' take on where you think the market is underestimating stocks. JP Morgan, Target, and General Motors. David Trainer joins us from NewConstructs.